delivering the world to your doorstep. From breaking news to in-depth features, from politics to culture, from science to sports. Welcome to SNN Primetime News with Kennedy Lucas Patterson.
Hello everyone, welcome back to SNN Primetime News. I'm Kennedy Lucas Patterson, and I'm here to bring you the latest of news of the top of the hour. Today is a very special episode because not only that we're reporting news today, but I will be joining the special reports team for SNN Primetime News. I wanted to bring to everybody's attention about the idea of the rise of groceries. Now, we all know that groceries have been the latest in topic of conversation to your average consumer, and everybody is struggling to find the right prices when it comes down to. Now, as retailers compete for grocery shoppers, some of the big names is obviously in business of having zeroed in on the same strategy. Get deliveries to customers' doors quickly. Now, this week, Target announced a new pay membership program with free same-day home deliveries as a key perk. Walmart has expanded its same-day delivery offering to allow shoppers to get online purchases dropped off earlier in the morning. And Kroger said on Thursday that home deliveries help propel more than 10% year-over-year growth in digital sales and 24% year-over-year jump in delivery sales in the most recent quarters. Now, this has been a interesting development as a lot of retailers, a lot of stores, they're getting ready. They're trying to get customers to have groceries into their home lives and have them in fast. It's been a raise when it comes down to groceries, averaging almost about 10 to 20% increase of your monthly spending when it comes down to groceries, where as inflation has happened into today's economy, a lot of people are very, very stressful when it comes down to groceries. These items can raise in prices when it comes down to eggs, milk, bread, and even potato chips have seen an increase in pricing. With the same-day delivery, the three retailers are not only trying to outmatch one another's on convenience, they're also turning brick-and-mortar locations, the short distance to customers' homes, into their biggest advantages over Amazon and other e-commerce players. Michael Baker, a retail analyst for D.A. Davidson, has reported. Now, I wanted to bring to the attention of this quote from Michael Baker. Now, this is a quote that he said, "This, over the last few years, has completely flipped the switch and turned stores into an asset," he says. Now, Walmart, being one of the largest grocers in the U.S. with a 23.6% of the market share in 2023, according to the Numerator, a market research firm, Kroger is the second largest grocer in the U.S. with a 10.1% of the market share. Target being the ninth largest grocer with a market share of just 2.7% from the firm's estimate. With Target's announcement this week, Walmart, Target, Kroger will all have paid membership programs with home deliveries as one of the benefits. The subscription service has similar prices, points, and minimums, such as the requiring customers to spend at least $35 within their order to get the goods dropped off at their homes. Target Circuit 360 will launch earlier this April, which will cost $99 per year, with it being $49 for customers who have the retailer's credit card for those who sign up during the promotional time at the program's launch. So we all know about the latest in subscription service, and Walmart Plus has been in the topic of conversation lately when it comes down to their subscription services for their consumers. Now, Walmart costs $98 per year, or with a $12.95 monthly cost basis, with perks like gas discounts along with free shipping and free grocery deliveries. And Kroger has a program called Boost, which is $59 per year, or the option of the 99 per year option as well. With higher price plans includes free delivery within 2 hours and all deliveries of $35 or more. Now, it's been the latest of Walmart and Kroger have not shared how many subscribers they have. Target said that it has 100 million members of the Target Circle. It's a free loyalty program, and it's unclear how many will sign up with Target Circle 360. Now, each retailer have tried to stand out from the pack. Target, for an example, said it can deliver same online orders in as little as 1 hour. Walmart said on Thursday that it will be making an on-demand delivery as early as 6 a.m. local time. Its previous start time was 8 a.m. Membership programs help offset deliveries and shipping costs by charging fees, but they also allow retailers to collect more customer data that can be used for personalized offers and support their growth advertising businesses. This is from the D.A. Davis's Bakers firm has said they can help drive more frequent online orders too. Quite a development when it comes down to the online grocery stores. We look forward to see what happens next within the big three grocery stores and to see how many consumers will be having this program.
Good morning, Atlanta. This is SNN by K.L.P. Entertainment. Gap's largest banner Old Navy returned to growth for the first time in more than a year during its holiday quarter as the retailer delivered earnings on Thursday that came in well ahead of Wall Street's expectations. Sales at Old Navy grew 6% to $2.29 billion, and Gap's overall gross margin surged 5.3 percentage points to 38.9% thanks to fewer markdowns and lower input costs. Analysts had expected a gross margin of 36%, according to Street Account. Shares of Gap jumped about 5% in extended trading following the report. Here's how the retailer did in its fourth fiscal quarter compared with what Wall Street was anticipating, based on a survey of analysts by LSEG. The company's reported net income for the 3-month period that ended February 3rd was $185 million, or 49 cents per share, compared with a loss of $273 million, or 75 cents per share, a year earlier. Sales rose slightly to $4.3 billion, up about 1% from $4.24 billion a year earlier. Like other retailers, Gap benefited from a 53rd week during fiscal 2023, and without it, sales would have been down during the quarter. The extra week contributed about 4 percentage points of growth during the fiscal fourth quarter, the company said. Comparable sales during the quarter were flat, compared to estimates of down 1.1%, according to Street Account. In-store sales were up 4% while online sales decreased 2% and represented 40% of total revenue. The retailer decreased inventory by 16% during fiscal year 2023, and with those levels now in check, Gap is working to hold the line on promotions and drive full price selling. During the quarter, Gap saw higher average selling prices across all of its brands, and it expects to grow its gross margin by at least a half percentage point in fiscal 2024. We were the authorities of taking on trend basics, expressing it in ways that drove cultural conversations. At its best, we were a pop culture brand that did much more than sell clothes, and as you know, we all know, we lost our edge. We devolved from a pop culture brand to a clothing retailer, and today we're moving again, CEO Richard Dixon told CNBC in an interview. Headed into the holiday season, Gap struck a cautious tone with its outlook as it warned of an uncertain consumer environment, and on Thursday, it reiterated those concerns. In the current quarter, it expects sales to be roughly flat, compared to estimates of down 0.2%, according to LSEG. For the full year, it expects sales to also be roughly flat, on a 52-week basis, compared to estimates of up 0.5%, according to LSEG. It's been a little over 6 months since Dixon, the former Mattel boss credited with reigniting the Barbie brand, took over as Gap's chief executive, and in that time, he's focused on breathing relevancy back into the retailer's legacy brands and getting him back to growth. Last month, Gap announced it had tapped fashion designer Zac Posen to be its creative director and Old Navy's chief creative officer. Given its size and contributions to revenue, Gap cannot succeed if Old Navy isn't winning, and for more than a year, sales have been down even at a time when consumers are hungry for bargains and affordable options. Posen, who got his start designing couture gowns and specializes in women's dresses, is a key hire to Dixon's executive team. He helps fill in the gaps when it comes to design and apparel, which are areas where Dixon lacks expertise as he's spent the majority of his career at a toy company. He'll also play a key role in reigniting cultural relevance across Gap, said Dixon. On the back end, Gap has made improvements in growing its gross margin and streamlining its cost structure, but it's been grappling with a steep decline in sales across its 4 brands, its eponymous banner, Old Navy, Athleta and Banana Republic. Gap and Old Navy have seen some signs of progress, but Athleta and Banana Republic have been dragging on the overall business. When it comes to Banana, Dixon told CNBC he is encouraged by the brand's aesthetic direction, but said it's going to take time to build back its momentum.
Job growth in the U.S. likely decelerated in February while still a long way from stall speed as companies continue to keep up demand for workers. When the Labor Department releases the non-farm payrolls report Friday at 8:30 a.m. Eastern Time, it's expected to show growth of 198,000 and the unemployment rate holding steady at 3.7%, according to Dow Jones consensus estimates. If the forecast is close to accurate, it would mark a considerable downshift from January's explosive growth of 353,000, but still representative of a fairly vibrant labor market. This is kind of a cautious labor market. Employers are hiring to keep pace with business activity, said Julia Pollock, chief economist at ZipRecruiter. Many businesses still report higher than expected sales. But they are not aggressively hiring for growth and to expand. For that, many are still taking a wait-and-see approach. ZipRecruiter's quarterly job seeker survey showed expectations for the medium-term outlook hitting a series high, while applicants also indicated stronger levels of confidence in their financial well-being and current state of the labor market. Under normal conditions, those would all be positive attributes. But there are other concerns now. A jobs market that remains red-hot could deter the Federal Reserve from cutting interest rates this year as expected. Earlier this week, Atlanta Fed President Raphael Bostic expressed concern about potential pent-up exuberance that could be unleashed in the business community after the central bank starts easing. Once rate cuts begin, that will give a boost to certain industries that they've been waiting for, especially when it comes to capital investments, Pollock said. Many companies are still holding back and waiting. Manufacturing will be a very interesting one to watch. There has recently been a bit of an improvement in durable goods.
In other latest development news, this goes out to all of our shoe lovers out there in the world. Foot Locker shares plunge nearly 30% as retailer poses holiday loss, delays key financial target. If you're a big fan of the Foot Locker stores, this will be a story for you. Now, I've been a fan of Foot Locker for quite some time now, and I've shopped there on occasion before, but shares of Foot Locker plummeted about 30% on Wednesday after the sneaker retailer reported a holiday quarter loss. This issued weak guidance of the current year and said it's behind on its meeting financial goals. Given how poorly the past fiscal year went, the company is now expected to be profitable and have the profitable goal it laid out during the March 2023 Investor Day to be delayed by 2 years. Now, the Foot Locker's chief financial officer, Mike Boss, said it now anticipates reaching the EBIT margin of 8.5% to 9% by the year of 2028. This was a quote for Bach. Of course, here how the company did the fourth final quarter year compared with estimates of analysts. Of course, earnings per share was 38 cents adjusted versus the 32-cent expected. Now, their revenue in expectations were $2.38 billion versus the $2.28 billion. Now, the company swung to a loss of the 3-month period that ended February 3rd. Foot Locker lost $389 million. Now, we often wonder, will it be because of inflation. We often wonder, is it because the cost of shoes, production of shoes, are they too high for the consumers? Or consumers are realizing that it may not be a smart time to go sneaker shopping when they know they have other priorities to maintain. Of course, we'll keep an eye on this story here on SNN Primetime News. That's going to do it for this episode of SNN Primetime News, top of the hour. I'm Kennedy Lucas Patterson. Good day, Atlanta.
Delivering the world to your doorstep. From breaking news to in-depth features, from politics to culture, from science to sports. Welcome to SNN Primetime News with Kennedy Lucas Patterson.